So right guys, let's dive straight into it. I'm gonna show you how I analyze the market in a simple way. Simplicity is the key, not overcomplicating things. So first you wanna do is a top-down analysis from the weekly. We see the overview of the market down to the daily, where we can find a direction and seeing we in the ascending type channel at the supply where we broke through. That's where we get straight in the wrong side of the market to continue to move down. So scrolling down to the 1 hour, this is where we're gonna analyze price. So you can see we got a nice resistance trend line. But we're gonna draw a structure now where price is correcting. So you wanna draw a equally angled triangle trend line as a support. So now we got a resistance and support. So in the structure we can see that price touched once, twice, and is now at the third touch of the structure. So knowing this and seeing our overall daily movement is down, we can start looking for sells. But that inverse hidden shoulder traps trades at the wrong side of the market. So from that third touch at our resistance trend line, we can start looking for sells. Let me draw up this area of supply with that purple box I drew. So looking at it, we can enter. Because on the 1 hour we look for candlestick confirmation, and seeing what candlestick pattern we have is an evening star. If you don't know candlestick patterns, you better go learn it. Evening star is reversal for bearish. With a green candle, small red candle, and an engulfing red one after the small red one. That three candlesticks is a pattern on its own. So with three confluences, we continue to trade. Boop, win profit. At this point, we can move our stop loss to break even, meaning it's a risk-free trade. So anything that happens now, we won't be able to lose any money. So as I'm going down to the 15 minute, I'm looking to scale in. That scale in means adding a position to existing position, but you only scale in when you're in profits, not when you're in a loss ever. So looking at price, we can see we had a nice impulse through our moving averages, and we're trading beneath it now. So let me just continue a bit to get the clue from the market if you can continue down with the trend. So this is the pattern. This is a continuation pattern. This is a pattern within patterns, meaning higher probability. Remember, trading is all about probability. So we got a nice second touch. Oh, there we get the third touch. Nice third touch. Looking for candlestick confirmation. Yeah, this looks quite good to me. So what I'll do is I'll place a sell order outside of the structure, outside of the bull flag. That's a bull flag. That's a pattern on its own. So you have to learn candlestick patterns and forex patterns. So I'll place my sell order right outside the structure. So when it breaks out, it will trigger us in the trade. It's better to use sell orders than execution orders, because anything can happen in the market. Just remember that. Okay, this is what the risk reward out. 1:2 or 3 always, meaning risk $1 to make 2, or risk 1% to make 2%. It's better you. So there we got triggered in, and boom, price just shot down as we played the bar replay. So boom, that's 2 trades. That whole pattern I just showed you now is like a strategy on its own. So as you see, I'm walking up now the bull flag with the third touch, giving us higher probability to move to the downside inside the bull flag. Just put that there. So as you can see, price impulse nicely out of the structure. Okay, with that green candle with the retest of the structure and the moving averages. And that's how we caught that massive sell-off. So you can learn your candlestick patterns if you search the Candlestick Bible, or you can read the book. And for trading patterns and all your forex patterns, I will be posting content on YouTube about it. I'm just navigating around, making these YouTube videos to help you guys learn in a better way, not having to learn all the unnecessary stuff of indicators, different patterns, not sticking to a pattern, not sticking to a plan. That's all disaster for trading. So now I'm just writing down why I took those two trades, the confluences I had to see to take, or the confluences I have to see to take a trade. So number one, you can see we impulsed out of structure. So I have two strategies I trade, and this is one of them, the continuation strategy. So for me to enter with my strategy or continuation strategy, price have to impulse out of structure. That's when we enter. Number two is the break and retest, meaning break out of structure impulsively, then moves in a corrective manner to retest the structure before continuing the move down. Also, I don't actually trade indicators that much, but I use the moving averages, the SMA and the EMA 8 and 9 for the periods. But that is just for a confluence, more confluences, because trading is probability, so the more probability the better. But as you can see, then sell at supply and buy at demand, meaning like by our first trade when we got to our supply area, daily supply area, we have to sell, and price broke through it, came back to retest, and that's where it got trade on the wrong side of the market, because now they're gonna want to buy, but actually price want to sell. So if you don't know price action and structure, you will get caught on the wrong side of the market and in a losing trade. So sell at supply, buy at demand, sell at resistance, buy at support. All this I will be learning on this YouTube channel as I'll be posting better and new content. Just make sure to like and subscribe. But number four is Nature's theory. Nature's theory meaning impulse, corrective, and impulse, because the market moves in threes. It's patterns that repeats continuously, which means the market is in a forever changing cycle. It could be impulsing, trending, correcting, moving sideways, consolidation, trending up, trending down. And number five is risk management. So how are you gonna manage your risk? What you gonna do in order to manage your risk? So I kept my losses at what 1% of my total equity, meaning I'm only willing to lose 1% of my total equity, and I have a fixed model that allows me to only risk 1% that I use and trade. Also, what is the probability of a successful trade? Is it going to be high, medium, or low? What is your risk to reward when it comes to risk management? Is it 1%, 2%, 3%? What is your risk per trade? Meaning is 1% to 4% for lower risk, or 5% to 10% for higher risk. Where will you place your stop loss? Will you have a module where you only place it 50 pips or you're gonna place it above the structure or pattern you see. When will you stop trading? That's also part of risk management. So yes, you have to know that also. Number six, risk to reward. As I said, so as you can see in the two trades, I only trade when it's a 1 to 2 risk to reward or 1 to 3% risk to reward, meaning you're only willing to lose 1%, as I said, but also willing to gain 3% on that trade. So if you lose two trades of 1%, that equals to 2, and you win one trade, that's 3%. 2 minus 3 still equals 1. So you will still walk away with 1% profit at the end of the day. So number 6, risk reward. Number 7, we have plan your trade and trade your plan, meaning to do forecasting on your positions. As you see, I did forecasting before I took a trade. Okay, the second one I didn't analyze on the charts, but I analyzed it in my head. Because if you study it and you learn this stuff by heart, you can like see it with the naked eye, the patterns. And if you actually do backtesting for a lot of months, you will be able to see it. But all this knowledge I'm giving away for free, and it took years to learn. And I paid courses to learn this stuff, but I'm gonna give everything for free here on YouTube. Hopefully helping you achieve consistency quicker. So plan your trade and trade your plan, because you will be more successful if you do that. Then the next one is accept the risk. Oh, this is a very big one because this comes to psychology, and this you're gonna have to learn after you're done learning all the forex patterns, strategies, concepts, terminologies, all that good stuff. But then you're gonna get to the big part of psychology. And yeah, you have to accept it, like literally accept it. Meaning, what I do is when I take a trade, and I start journaling, I always write down that I accept the risk and that the trade can be a winner or loser regardless the quality of the setup. That's what I do. So yeah, the next one is number 9, price and time meets. So this is actually just the pair trading and the session and the time. Meaning if you're trading pound pairs, it's most likely to move in the London session the most, and at 10 o'clock to 11 o'clock for peak performance, because if you backtest it, you will know. So that's where price and time meets. There's also deeper meaning behind where time and price meets that I learned at ICT, Inner Circle Trader. You can search on YouTube, but that's for another time. But the 10 rule is, or the 10 confluence is, always protect your capital. That's rule number 1. Always protect your capital. Don't go for big risks and big wins, because that's not how forex works. Small risks, big wins. The trade must end in 4 ways: either small win, big win, small loss, or break even. Remember that. So all the knowledge that's about to be shared on this YouTube channel of mine is going to be very impactful. I can see it coming because I'm going to see all the stuff that other traders don't want to share with you on YouTube. But I'm going to do it to the best of my ability and post more content. So as you can see, continuing with the strategy, we broke through possibly of our previously support area with a purple box. Now we busy consolidating beneath it and placing a sell order just outside the support area that was newly created. We're looking to enter with our risk reward being on point, our risk management